With that being said, I'm going to jump right into the on-chain data with GLASSNODE. And this is for this week, the week of the 30th. And we saw a crazy short squeeze happen Sunday evening, Monday morning early. So with that, as we open the week, open interest in the options markets suggested that volatility was expected. So we saw this on Sunday around 5 p.m. Pacific Standard Time. That's when UTC Monday morning opens. So if you're not familiar with that, you should look up UTC, Universal Time Zone. Anyway, open strike price 1 month out, August 27th, contracts show a notable preference for strikes well outside the current consolidation range. So we see we got shorts in for around 25K with 1,388 Bitcoin in open interest. Then on the other side, we see an $80,000 Bitcoin call with 1,500 and some change in Bitcoin in open interest. So this is what they're talking about right here. Here's the shorts and here's the longs. And then this is the consolidated trading range. So this is where you need to be ultra careful. And this is where you can get wrecked the most. So that's why we saw a record breaking short squeeze happen. So perpetual futures open interest climbed by a notable 1.4 billion alongside the rally in price. Oftentimes, elevated open interest starts to increase probabilities of a volatile leverage squeeze occurring. Basically, that's what happens when you see a lot of money aping into the markets. The market makers are going to manipulate it and make it work in their interest. So, in general, cash margin positions are preferable for market stability as they remove a layer of risk that is present when volatile crypto margin futures dominate. So, as we could see with the price of Bitcoin coming down in calls, we saw the interest of money flowing in. So we could see as the market started to go down that these calls got lower and lower and lower. So confirming this trend, we can see the relative dominance of crypto margin futures positions has been in structural decline over the same period, falling from 70% down to 52.5%. So this is the percentage going down. So this is when we saw margin accounts starting to not be used. This is the decline of them. So that's quite a bit of jump, about 17.5%. So to assess the directional bias of futures market, we can see that perpetual funding rates have continued to trade negative. This indicates the net bias remains short. That means that more people are thinking it's still going to go short and still going to go even lower. So this metric in particular helps us identify that Monday's price rally is likely associated with an overall short squeeze, with funding rates continuing to trade at even more negative levels despite price rallying 30%. So let's jump into this right here. So nearly $900 million in crypto shorts were squeezed in a single day as Bitcoin surged into the 40K region. So to get a little more particular, 883 million worth of shorts were liquidated in a 24-hour span amid the rally to 40K. Data from Bybit also shows that Bitcoin accounted for 81% of the squeeze, with 750 million liquidated on Bybit alone. So most of the crypto short liquidations happened late Sunday night as Bitcoin's price spiked 10% to break the 39 level for the first time in 6 weeks. So here's a quote from Ryan Todd, researcher at The Block. He said, "We've seen this in the past when Bitcoin has entered a choppy trading range for several weeks, meaning just up and down, sideways, consolidating, boring trading, with traders positioning towards a bearish bias." Todd said he cited $1 billion liquidation late in December when Bitcoin broke past 20K and a January $800 million liquidation when Bitcoin passed 30K. So this is pretty normal along the journey of Bitcoin going up and down. It's just the volatile nature of it. So with that being said, I'll just jump into this article real quick. Fed faces double inflation as supply chains falter. Economist questions spending And apparently Biden is not worried at all because he's got the money press in his back office. So, all right. A few analysts believe the upcoming 2-day meeting held by the U.S. Central Bank's Federal Open Market Committee will give us market clues on whether or not the Federal Reserve plans to taper quantitative easing and raise interest rates. So quantitative easing, real quick, is when short-term interest rates are at either zero or approaching zero, the central banks pump more money. So real quick, quantitative easing increases the money supply by purchasing assets with newly created printing money, bank reserves, in order to provide banks with more liquidity, basically for them to put more money in their vaults. So in response to that economic shutdown caused by the C word in pandemic, on March 15, 2020, the U.S. Federal Reserve announced a quantitative easing plan of over $700 billion. And then again on June 10, 2020, after a brief tapering effort, the Fed extended its program, committing to buy at least $80 billion a month in treasuries and $40 billion in mortgage-backed securities until further notice. So that's how this worked. The Fed prints more money and then they buy more stuff with it, pumping the economy even higher.
And if you did enjoy, please be sure to like and subscribe below. And also stay tuned for future daily updates, weekly podcast. As always, remember, nothing but love. Stay C3. Cool?
Calm.
Collective.